In mutual fund, one of the most important thing that you will come across is identifying and getting the definition of different types of schemes. Now, you must remember one sentence that I said you in the other classes in the other program is mutual fund. In mutual fund, investor invest in the scheme of AMC, but in the name of trust. So, what are those schemes of mutual fund? What are the different kind of funds that mutual fund is offering to you? And then comes the classification. Who will classify that? SEBI has given you mandate to make a classification. You can see over here. In terms of a structure, you have an open-ended, closed-ended interval. Open-ended is something where you can invest at any point of time and can withdraw at any point of time. Closed-ended is something where you will invest only in NFO, new fund offer, and then you wait till its maturity to happen, and then you can withdraw the money. Now, interesting thing is that there are a scheme in open-ended fund where you will have a lock-in feature, like for tax schemes like ELSS, Equity Linked Saving Scheme. I will give you example details of this scheme little later. So in open-ended category, like schemes like ELSS has got 3 year of lock-in. So many people get confused whether this lock-in should be called a closed-ended. No, lock-in still allow you to invest into the schemes. It just give you restrictions to withdraw for just 3 years in ELSS account. So open-ended fund, you will have a free entry and free exit. Unlike closed-ended where you have to wait till the maturity to arrive. Now, when maturity to arrive, till then, what happens if you want to have a liquidity? So there is a rule in mutual fund, and that rule says that every closed-ended mutual fund schemes are to be compulsorily listed on the stock exchange. That means if you want to withdraw, you can sell your units at the stock exchange. Whosoever will be the buyer at a mutual price, what you decide over there between buyer and the seller, you can sell it on the stock exchange. So open date is different, closing date is different. An interval will have a both kind of features. It will be open for some point of time, will remain closed for some point of time. A very standard declaration is there that an interval fund remains open for minimum 2 days and maximum 15 days. Very important sentence, must keep it in the mind. Fine. Then you can say other classification other than the structure could be the method of management. Now, one would be active management, one is the passive management. So, active management and passive management is to deal with the research ability, equity research, stock research, security research. In certain schemes of mutual fund, the fund manager will be doing a lot of research. Why will they do a lot of research? They will do a lot of research to outperform the benchmark. And you know the benchmark. What is benchmark? It's a sample of entire market. Example, Nifty 50, BSE Sensex 30. So whenever a fund manager will do a lot of research to pick up good stock, to create a good portfolio so that they can outperform the benchmark, that is called active fund management. But when this research is not needed because offer documents tell you as the benchmark is there, similar should be the portfolio. Both should be similar, identical, mirror image. Example is index fund. I will tell you a little more on the index fund very soon. So this is passively managed fund. So active and passive is basically how do you approach the fund management skill. That is also very popular and a lot of questions come from this area. And then one we have discussed in the last class as well, the different types of mandate of the fund, like whether mandate is for equity investment, mandate is for debt investment. Who has given you mandate? The fund manager receives mandate from the offer document. What is offer document? It is a legal document available for each schemes. Each schemes are launched in market after the offer, as per the offer document. No, it's a legal document. So if the mandate in offer document says you that portfolio will be consisting of equity securities, equity instruments, it will be equity instruments. So portfolio means a scheme. So we will see the calibration of different types of schemes, different types of instrument into that. Fine. Now, if you proceed from here, let us see how the schemes calibration, scheme classifications can be identified with. Now, who has done this classification? SEBI has given this mandate to mutual fund to launch schemes in different categories. Remember that, fine. Now, whatever I am saying over here is just based upon only for the open-ended category, not for the closed-ended. In closed-ended, mutual fund can come out with as many schemes as they want. But in open-ended, they have certain restrictions. SEBI has put those restrictions that comes under the scheme classification. So in equity, you will find 11 types of equity schemes, open-ended. In debt, you will find 16 types of schemes. In hybrid, you will find 6 types of schemes. In solution-oriented funds, you will find 2 types of schemes. Solutions are for basically one for children's financial planning and one for retired person. So how should we create portfolio in a scheme according to their need? And 2 schemes are the special schemes. So these are the different classification. Remember that very particularly on all this classification. So here, one word that comes very often when we go into the equity schemes classification is that market capitalization. Now, this is a stock specific explanation and definition. What is market capitalization? It is a total market price of a stock multiplied with the outstanding shares in the market. No, so suppose any share, any company has got 100 crore shares in the market, and the present price of that stock is say 50 rupees. So 50 multiplied by 100 crore, that means 5,000 crore rupees is the market capitalization. Fine. So in India, you will find nearly 4,000 stocks are listed. So if you arrange them in descending order, descending means the highest will be having the top, biggest will be the top. So descending order, the first 100, you can see down in the screen, first 100 is called large cap. Large cap means big companies. No, large cap, market capitalization. And then next 150. Next 150 means a starting 101 to 250 company is called mid cap, and then all remaining company is called small cap. There is no concept of micro cap now. Years before it used to be there. Now SEBI has made it very, very specific. There will be 3 kind of market capitalization stocks classification. One is large cap, then mid cap, then small cap. Fair enough. Now we are going to use this very frequently in the coming 2 slides. Look at the different 11 types of equity schemes that you have. Large cap, mid cap, large and mid cap. So you can say cap means market capitalization. So large cap means top 100 stock, mid cap means next 150 stocks, large and mid cap means top 100 plus 150, that is 250 stocks put together. Small cap, after all 250 is a small cap. Multi cap, where you have a large cap, you have a mid cap, you have a small cap. So this way you will have all the different kind of market capitalized based stock schemes are there. And look at the minimum investment ceilings. You will have to remember this. Large cap, the minimum ceiling is 80%, mid cap 65%. 65% means what? It means that in that portfolio, at least 65% investment should be made in the mid cap stock. So similarly for large and mid, small cap, no, this you must remember that you should not make mistake into this. Then there are sub fund like dividend yield fund, value fund, contra fund. No, dividend yield fund are basically schemes which predominantly designed to invest in those stocks which gives you regular dividend. Means uh, schemes, they try to give you regular dividend. That is the way they design their portfolio. That is the way they approach their portfolio making. So this dividend yield fund is good for certain financial, those who have got certain kind of financial goals. It is good for them. No, then you have value stocks. Value funds are basically, value fund or value stocks are funds which is basically undervalued as of date. The current market price could be less than the intrinsic value of the stock as of date. But going forward, if you stay for long, you will find the value funds will be outperforming the market. The stocks will be able to realize the value. So value funds are undervalued as of now, but more likely if you stay, it will outperform the market. It will give you good performance. No, contra is about following certain investment strategy, which is called contrarian. No, that means ulta, vipareet. No, something opposite. So contrarian investment strategy is where you create a portfolio contra fund. That is also quite popular. Focused fund, where you have to have a ceiling of a stock not more than 30. No, see, in all other schemes, the number of stocks can be 50, 60, 70, depending upon how the fund manager feels as an opportunity and also how the offer document of the schemes allow you. But in focused fund, you have a restrictions that you cannot invest in more than 30 stocks. No, and then you can have a large cap bench, you can have a mid cap benchmark, you can have a small cap benchmark. Depending upon the kind of benchmark that offer document has allowed you, the focused fund will be investing in that benchmark, but maximum is stocks will be 30%. That is what you have to keep in mind. then you have a sector fund, then you have a ELSS fund. We discussed about ELSS fund, that you invest in this kind of a stock for getting tax benefit under section 80C. No, so these are the different 11 types of equity schemes that you must understand. And then beyond this, you have a debt schemes. So after equity, if you invest in debt, then you have a 16 types of debt schemes, and that is very, very important here to understand. Now, the total 16 schemes you will find are designed to address two different kind of risk. In my another video, you will find the detailed discussion on the risk, and you can solve the questions through MCQ on these different topics. So two different kind of risks. What are those two different kind of risk which is basically used in the creation of data scheme? One is interest rate risk and one is credit risk. Now we'll discuss at length, at detail about this interest rate risk and credit risk little later. But in this video, just accept it that there are two types of very, very important risk in debt fund, and that is called interest rate risk and credit risk. Now, what interest rate risk means to you? Just 2 minutes you will understand that. Longer maturity of a bond, longer maturity of a scheme, that basically represents higher interest rate risk. No, so if you say, yes, in last class, I remember we discussed about money market instrument. So less than 1 year maturity. So lower maturity, you can see over here, overnight fund, just 1 day maturity. Liquid fund, just 91 days maturity, less than 91 days maturity. No, ultra short duration fund, 3 month to 6 month maturity. Low duration fund, 6 month to 12 month maturity. Money market fund, up to 1 year. So you can see in these 5 schemes, overnight, liquid, ultra short, low, and money market, the maturity is basically less than 1 year. That means it is deploying most of its investment into money market instruments. So shorter the maturity of a bond, of a debt instrument, or you can say shorter the average maturity of the scheme, so lower is the interest rate risk. So of course the risk comes down, and so your returns should be also in the same manner. No, but if you proceed from here to a medium to long term bond, and then you will find the interest rate risk going up, and so the earning potential will also go up definitely, because risk goes up, and so earning potential also goes up. Now, if you go beyond that, you will find some of the schemes are like corporate bond fund, banking and PSU bond fund, credit risk fund, gilt fund. No, so these are instruments. So these are the different types of schemes. So in this scheme, you will find there's something called, this scheme is designed basically to address the credit side, credit risk of the issuer. So what it means, suppose government is issuing a bond and we are investing in that bond, gilt fund. No, suppose corporates are issuing a bond and we are investing in that bond, corporate bond fund. Good corporate. When I say corporate, means good corporate. If I say banks and PSUs are issuing bonds and we're investing in those bonds, that's the banking and PSU fund. And if you say companies who are good, of course, as per the permission given by the SEBI to allow into certain kind of category of credit risk, on that it is of course okay, but then it is a more risky, it is a more credit risk worthy compared to corporate bond, compared to banking risk, and compared to gilt. No, so then you can say, oh, credit risk fund will have a higher credit risk, and so will give me higher return compared to gilt fund, compared to bond fund. Bond means banking and PSU bond fund, and corporate bond fund. No, so this way it is designed. And then if you look on the right side, and then you will find that how their alignment with the benchmark is designed. Corporate bond fund, 80% has to be in double A plus. Now you can say, what is this double A plus? Credit risk fund, 65% below double A. No, so what is this double A plus or double A, no, or GSEC? So these are nothing but rating notation. This represent the credit risk. We'll discuss at length about interest rate risk and credit risk. The more risk you take in your portfolio, the higher return you are able to generate for your investor. But then it depends upon the investor's risk appetite whether he is willing to take that risk or not. No, so a financial manager, a wealth manager, a mutual fund distributor should know about different types of scheme, different type of capital market instrument, and thereby the also the risk taking ability of the investor, and then they match to create a good wonderful bundle of portfolio combination of schemes. No, this way we address equity and debt, and when we put these different types of instruments at one place, that becomes a hybrid schemes. And you know there are total 6 types of hybrid schemes. That way this scheme definition, please listen to this video a couple of times to understand basically the different types of definitions and the underlying identification. Then you go and read the notes that I have sent you and attempt the questions in the MCQ, then this part will be very, very clear to you. Okay, good. Thank you.